Uncertainty in the stock market could be a blessing or a curse. You could make money in the stock market, but you can also lose it. Now, some would call this an opportunity to make money, but that doesn't mean it's a guarantee. So let's take a look at the stock market and how it's done throughout the pandemic. What's really driving the stock market? But most importantly, let's take a look at how the stock market fares through an election and from the election to the end of the year. But before we get into it, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner, helping you reach your financial goals. So I'm going to pull up a whole bunch of charts so we can take a look at them and really get an understanding of where the market's been, where it is right now, what's driving it, and what you can expect moving forward from the election and the stock market. Now we're going to look at the S&P 500, which is an indice that looks at the 500 largest US companies. So let me pull it up on the screen, and this is a chart in real time of the S&P 500, and I also have the Dow Jones up there as well. But the S&P is in red, and you can see that it is up 6.92% year to date. And this is a real-time chart, so it is fluctuating. But right now, it's just below 7% year to date. But it's a very different picture if you're looking from the low to the high, where in March, it was down 30.68%. And then now year to date, it's up 6.92%. But from that market bottom, it's up significantly more than just 6.92%. But what's really interesting about the S&P 500 right now and its sharp increase from the market lows of March is the fact that so much is being driven by just a few stocks in the S&P 500. So let me pull up this chart right here, which shows us the top 5 positions of the S&P 500 having a total rate of return of 40%, where the rest of the S&P 500, the other 495 stocks, are down a combined negative 5%. So when you're averaging those out, that's where we're getting that rate of return year to date of just below 7%. And the reason that this chart is so interesting is because this is really a good indicator of why it feels like the economy is not doing well. But then when you look at the stock market as a whole, like the S&P 500, that it's up significantly. And it's because there's only a few drivers that's driving the entire stock market. So the entire stock market isn't doing quite as well as everyone thinks, but it's just a few positions. Now let's take a look at this other chart so we can see visually really what this looks like. And this is more of a visual representation, and the size of each square with each position or each company or each stock is in relation to the size of its weighting of the S&P 500, but the S&P 500 is weighted by the size of the company. So you can see that what is driving it is these few tech stocks, including Apple, Microsoft, Google, Facebook, and Amazon. And that's why they're much larger than the other positions. And you can see from the heat map that the green represents those companies that are in the positive and the red are in the negative. And I'll also point out Berkshire Hathaway, which is run by Warren Buffett, is down 7.73% year to date. But just like in March, there was a lot of uncertainty about the stock market, and that's what also drives it down because people get scared and they take their money out of the stock market. But if we just take a step back for a second and look at all the epidemics and pandemics since the 1980s, here's a chart representing all the pandemics and epidemics since 1980s. And yes, there was a much sharper decline from COVID-19, and we can see it right here, down 33.9% from the peak to the trough, from the high to the low, averaging 8.3% on the downside. So that is significantly more for COVID-19 than these other pandemics or epidemics. But if we think about it in terms of buying low and selling high, we're seeing that the S&P 500 is up right now, and it's up significantly from March. And if we go from this chart right here, where we saw the 5 top S&P 500 stocks, which were tech stocks, up 40%, but the rest of them were down 5%. If we look at the breakdown of the S&P 500 into deciles, so in each segment is 10% of the S&P 500 or the companies, and the smallest of the companies are down 21%, and the next are down negative 18%. So overall, the S&P 500 is up, but the vast majority of the S&P 500 stocks are down. And there are two ways that we can really look at the stock market and individual stocks. We could either look at the market as a whole, like the S&P 500, or you can look at an individual stock and figure out whether or not it's undervalued and whether or not you want to buy it. But if we look at the market as a whole and how it's done from the election to the end of the year, because that is really what we're gearing up for right now, the election is right around the corner. So let's take a look at some historical numbers and how it's worked out from the election to the end of the year. So this is going back to 1928, and this is how the S&P 500 has performed from election date through the end of the year. So if we look back to 2016, when Trump got elected, the market was up 5% from election to the end of the year. And you could see that it's pretty dispersed between Democrats and Republicans. But if we look at the average, the Republican election, the market was up 3.1% on average. And for a Democrat election, it was up 0.1%, with all periods up 1.5%. Now, I'm not telling you whether or not you should invest in the stock market or not. I don't make recommendations on this channel. But if we're looking at historical numbers in election years, from the election to the end of the year, on average, the market has been up over that time frame 1.5%. If it's a Republican, it's still positive. It's a Democrat, it's still positive on average. But again, that doesn't mean that the market is going to be up from the election to the end of the year. But even if we tied in the pandemics and the epidemics, the market still rises over time. Yes, there's volatility, but if you stay the course, the markets rise over time. Of course, that is historical numbers, not a guarantee of future returns. But it is an interesting perspective when you're looking at the stock market and realize that the S&P 500 is really being driven by just a few stocks. But just like we saw earlier this year, the higher the uncertainty, the greater the opportunity. It just so happened that this opportunity turned into positive returns. But again, that doesn't always mean that it's going to be positive just because there's volatility or uncertainty. And that first stimulus check and stimulus package really turned things around, but more so on the uncertainty part, that it reduced uncertainty because it was such a huge stimulus package. So it's possible that we can get that second wind from a second stimulus check or a second stimulus package. But of course, Congress hasn't agreed on it just yet. So we're just gonna have to wait and see how that pans out. And Federal Chair Jerome Powell seems to think that another stimulus package could give the economy a boost, which will probably also help out the stock market. And even though we hear this time is going to be different, it's funny how history continues to repeat itself. The market continues to rise over time. But again, historical numbers are not a guarantee of future returns. And let me know in the comments down below what you think of these charts and the stock market from the election to the end of the year. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.